Even influencers have to pay taxes, but are you overpaying taxes? Number one, expenses. Think about your expenses. If they are wholly and exclusively for business, please consider these in order to reduce your tax liability. I know it's simple, but it's easy to miss. Some common ones for influencers would be your social media fees. So you pay monthly for your Instagram, your X account, your TikTok page, whatever it might be. Now, these can be deductible if they are wholly and exclusively for your business. As influencers and the way that your profession works, this could well be the case. Maybe you have some equipment or software because you're recording content. For example, this microphone or that webcam over there. Now, these can be tax deductible if you need them for your business, of course. Maybe you're on X and you're doing giveaways to amp up your actual following count, for example. Now, all of this can be something you could use. Definitely something to think about. Now, a controversial one, I guess, would be you buying followers, likes, comments. Now, I'm not saying people do or don't. I'm just saying if this happens, if it's for the growth of the business, and it's that phrase, wholly and exclusively for business, you might be able to use those costs to reduce your profit and therefore reduce your tax liability. The last one is more about staff and wages. So if you have any helpers, for example, maybe you've got someone who is a ghostwriter. Maybe you've got someone that manages your accounts once you have a fair few that you're looking after. Maybe you just have someone that takes care of the day-to-day or books in what you're looking at, when you're going for a photo shoot, when you're going to write an article, whatever it might be. It really does depend on what type of influencer you are, or KOL, whatever it might be, inside or outside the crypto space. The next one is receiving crypto in lieu of payment. Now, if you're an influencer receiving payment through the blockchain, your first question might be, how do you track that? What are you putting down on your books to make it appropriate? It's got to be the market value at the point that you receive beneficial ownership. What does that mean? In layman's terms, at the point you receive the crypto in your wallet, how much is that worth in fiat, in GBP, if you're in the UK, for example? So that would make up your turnover, and any expenses if you were to dispose of crypto assets for something that's wholly and exclusively, that would be at the same sort of market value at the point of disposal. So it's all about timing, I guess, if anything else, that would help. But what you have to remember is with these things, if you are receiving, say, Bitcoin for payment as an example, that will include your tax amount as well. You need to kind of put away your tax money, they say. So if you're a carpenter receiving fiat, you'd put away 20% or something like that into a different bank account, or just to the side in anticipation of your tax liability. Now, with crypto, for some reason, when you're receiving crypto in lieu of payment, people forget about that. So really, it's as if you've got your money, you put your money aside for taxes, and then you're putting your tax money into the crypto space, which is very risky. I mean, if you go from a bear market to a bull market, you're not really going to complain or know about it. But if you go from a bull market to a bear market, you're in a sticky situation here, especially if you are paid outside of stable coins, for example. So let's say you receive £10,000 worth of revenue from your business as an influencer, and you then get into a situation after the tax year end when you're starting to look at your taxes, where that £10,000 worth of crypto goes down and it's worth £1,000. Now, even if you liquidate that, you don't have enough to cover your taxes if the taxes were, say, £2,000. So you're in a really sticky situation when you created a capital loss, but you can't use capital losses against your income, and you're stuck with a large tax bill. Now, this number could be astronomical as an example. So be very wary of that. And that happens if you don't put your tax money aside. But what if you're paid in native tokens? You can't dispose of them because there's no liquidity, or your contract says you can't because it's going to affect the markets too much. That's a lot more difficult, even if you know you're going to deal with this and you're trying to hit it head on. Maybe negotiate so that the tax proportion is in fiat or stablecoin, for example. How much do you want to put aside? It depends how much you're making, how much you expect to pay. Anywhere from 15 all the way up to 50% is appropriate. Again, depending depending on how much you're making and what tax bracket you're expecting to be in. Obviously, if you're making that much money, you probably have an accountant somewhere to give you a bit more of an accurate figure. So by all means, ask us. So the other part of this is when you have crypto assets and you eventually dispose of them, you're actually creating a second taxable event. So the first one is receipt in lieu of payment. The second one is disposal. It might go up or down, but you're going to create a gain or a loss. Now, if your base cost is incorrect for your receipt, that means your income will be incorrect. Therefore, your tax will be incorrect, which means your capital gains calculation will also be incorrect because the base cost is out, and therefore that tax is incorrect as well. So the base cost is very important at the point of receipt. Again, most softwares should pull that, but please check all of the base costs even outside of something like this. Third one is to think about VAT. Now, I know with this type of business, there's a lot going on, especially if you're within the crypto space as well. But just bear in mind that magic number of £90,000 per annum. So on a rolling 12-month basis, you can't breach that £90,000 before you need to start looking at VAT. So when you're about £80,000 or so, you need to start preparing yourself, especially if you anticipate, increasing that revenue, not profits, revenue. So before your costs. Now, in order to do so, you really need to be on the ball and know what's going on with your financials at any given moment, or have a very good idea. So you'd need to look at them at least every 3 months, so every quarter, if not every month. When you start to approach this with VAT, if you don't start charging it and it turns out that you need to pay it, you're going to be paying 20% off the top in some cases to the government, which is not good for anyone, and you're just going to suffer with that. So you really need to be on the ball with that. And when you actually do start to deal with this, your customers, you need to know where they are in the world. The reason for this is you will then determine if it is inside or outside the scope of VAT, which means sometimes you don't have to charge that extra 20%, therefore being able to charge them a lower fee. And if they are inside, you have to pay the VAT. So you really should pass on that VAT charge in most cases. I don't see why you wouldn't want to. So be very careful with VAT, and bearing in mind you might be able to have a flat rate scheme in some cases. So perhaps as an advertising consultant, which I believe is 11% flat rate, depending on what you actually do as an influencer cold type person. So the next one is payments on account. What is that? So this is when you are a sole trader, as an example, and you have taxes to pay to HMRC. They expect you to pay the same amount again ahead of next year's taxes. So say you've got £10,000 worth of taxes to pay, and certain other criteria are met. Don't worry about that just for now. And you pay that £10,000 by the end of January following the tax year. HMRC in this situation will expect you to pay another £5,000, so 50% of it by the end of January, and another £5,000, the other 50% by the end of the following July. This means you've prepaid the next tax year's liability by £10,000. So when you do get around to that, the first year sucks. It really does. But once you get the hang of it, it will be second nature and it does start to flow. So what I'm saying here is, if you get your books in early, before July, before that second payment on account, and say, for example, your profits are lower, and you know they are, or you fully expect them to be at this point, you can reduce your payments on account to be lower. If you get this wrong, there will be interest, etc. So you really want to get this as accurate as possible. So if you get your taxes done, say in June as an example, and you find out your liability in this example is now £5,000, not 10 as you would probably have hoped, you can reduce your payments account, and in this situation not pay your second payment account in July because you've already paid the £5,000 in January. If it was £6,000, you just top it up by the following January by £1,000. You do need to notify HMRC of this, but it will save you potentially a lot of tax depending on your situation. I say save you, it's more of a cash flow situation because you can get it back eventually, but £1 now is worth more than £1 next year. So let's have our money in our own back pockets when we can. Finally, the last thing you need to think about in order to save taxes is going limited. This isn't for everyone, and in certain situations it is the perfect tax planning opportunity for the individual. So this is where you actually incorporate your business into a limited company setup. This is when you can start to have some fun with the tax planning. So you might have a director's salary followed by some dividends. Maybe you're a little bit frugal and you keep a lot of the profits in the business, so you don't need to pay dividend tax on it. Really start to tax plan and save your money. If you have a wife, husband, civil partner, maybe you want to get them on as a director or shareholder because they're involved with the business. Again, another way to extract that cash out from the company in a tax efficient manner. There's lots of things you can do. Now, this isn't for everyone, and you might ask, okay, at what point do I want to do this? I recommend looking at it at around about £85,000 total income. Again, it could be at 70, it could be 110. It really depends on your situation. But start thinking about it at some point. If you start to, want to pay to save taxes with an accountant, much like us, you can go to most accountants and ask them for an introduction and a discussion about this. There's lots of articles online as well, so incorporating might not be for everyone, but certainly something to keep an eye out for. So incorporating might not be for everyone, but it's certainly something that you should have in the back of your mind. Perhaps not at the start of your journey, but when you start to really hit the ground running. So if you're an influencer, you are absolutely welcome to have a chat with myself. And of course, any comments down below, I'll get to you as soon as I can and try and answer those to the best of my ability. So please do like, comment, subscribe, all of these things, and tag an influencer below that you think might actually benefit from this. You never know, you might just save them a small fortune.